Listen to me very carefully, because what I am about to tell you could save you tens of thousands of dollars in your golden years. Most people spend 30 or 40 years saving money for retirement, and they believe a massive myth. They tell themselves, when I stop working, my income drops, so my taxes will drop too. I will be in a tiny tax bracket. I won't have to worry about Uncle Sam anymore. If that is what you are thinking, I need you to wake up right now. Because if you do not understand how retirement tax brackets work before you hand in your resignation or take your first withdrawal, you are walking into a financial trap that you cannot easily escape. You work too hard for your money to give a massive chunk of it back to the IRS simply because nobody explained the rules of the game to you. When you were working, your tax situation was simple. You got a W-2, taxes were taken out of every paycheck, and you paid income tax on what you earned. But when you retire, everything changes. You are no longer living off a single paycheck. You are living off a puzzle made of different income streams: Social Security, pensions, traditional 401(k)s, traditional IRAs, Roth accounts, and brokerage accounts. And every single one of those pieces is treated differently by the IRS. Here is where the fear sets in for so many retirees. You pull money out of your traditional 401(k) or IRA thinking it is just your hard-earned money, but every single dollar you take out of a pre-tax account is taxed as ordinary income. That means every dollar gets stacked right on top of your other income. And if you are not careful, that money pushes you right up into a higher tax bracket. And it gets worse. People ask me all the time, Susie, is Social Security taxable? The answer breaks my heart because so many people don't prepare for it. Yes, up to 85% of your Social Security benefits can be subject to federal income tax if your combined income exceeds certain thresholds. Think about that for a second. You paid into Social Security your entire working life with after-tax dollars, and when you finally draw it out, the government wants a piece of it again if your other taxable income is too high. Then comes the silent retirement killer that trips up almost everyone: required minimum distributions, or RMDs, up until age 73 or 75, depending on when you were born. You control how much you withdraw from your pre-tax accounts. But once you hit that mandatory age, the IRS steps in and says, time's up. You must take money out, whether you need it or not. And if you have built up a big balance in a traditional IRA over 40 years, those mandatory withdrawals can be huge. They drag you into a higher tax bracket, they trigger taxes on your Social Security, and they can even trigger IRMAA surcharges on your Medicare premiums, making your healthcare more expensive. You see why people panic? They feel trapped. They feel like no matter what they do, the system is designed to take away what they sacrifice to build. But I want you to take a deep breath. Stand in your truth. Because knowledge is power, and you are not helpless. You can control your tax destiny in retirement if you take action before it is too late. To win this game, you have to understand how tax brackets actually work. We have a progressive tax system in America. That means you don't pay one flat rate on all your money. You fill up tax brackets like buckets. The first bucket is taxed at 10%, the next bucket at 12%, then 22%, then 24%, and so on. Your goal in retirement is not necessarily to pay zero taxes, though that would be nice. Your goal is to keep your income inside the lower tax buckets, like the 10% and 12% brackets, and never spill over into the higher brackets accidentally. So, what is your actionable takeaway today? What do you need to do right now? First, you need to create a tax-diversified retirement strategy. You cannot keep all your eggs in the traditional 401(k) basket. You need 3 distinct buckets of money: a taxable bucket like a standard brokerage account, a tax-deferred bucket like your traditional IRA, and a tax-free bucket like a Roth IRA. When you have money in all 3 buckets, you control your taxable income every single year. Need an extra $20,000 to buy a new car or take a dream vacation? You don't pull it from your traditional IRA and knock yourself into a 22% or 24% tax bracket. You pull it from your Roth IRA or your brokerage account tax-free. Second, look closely at the gap years. What are the gap years? It is that golden window between the day you retire and the day you start taking Social Security and RMDs. During those years, your taxable income might be lower than it will ever be again. That is your opportunity. Use those years to execute systematic Roth conversions. Convert a portion of your traditional IRA into a Roth IRA each year, paying the tax now at the lowest possible tax brackets, like 10% or 12%. Once that money is inside the Roth, it grows tax-free, and when you withdraw it later, it is 100% tax-free. Plus, Roth IRAs have no required minimum distributions for you during your lifetime. You effectively defuse the RMD tax bomb before it ever has a chance to explode. Third, if you are over age 70 and a half and you give money to charity, never give cash from your checking account. Use a qualified charitable distribution, or QCD. You can send money directly from your traditional IRA to a qualified charity. It counts toward your RMD, but it never shows up in your adjusted gross income. That keeps your tax bracket low, keeps your Social Security untaxed, and keeps your Medicare premiums down. People, hear me on this. Do not wait until April 15th to think about taxes. Tax planning in retirement is a 365-day-a-year strategy. Take control of your money. Understand your brackets. Do not let fear rule you when action can protect you. When you master your taxes, you master your retirement.